All right, guys, welcome back for another video. In today's video, I want to make the case for Ethereum, the bullish case for Ethereum, and talk about how it fits into the macro framework, of what's going on in the world, and also talk about a very specific trade that is surrounding the merge. I was talking to some guys in the Discord, and we were talking about the Ethereum positive carry trade. If you guys haven't seen my previous video titled Ethereum positive carry trade, I strongly suggest you check that out. It was uploaded about a few weeks ago. But basically, the idea is that the upcoming Ethereum Merge, targeted for September 15th, offers some very unique opportunities within the market. And, for all intents and purposes, it's assumed to occur on September 15th. Now, it could be delayed or canceled, but, that is the expectation of the market. And, if the merge is successful, it will have a very fundamental bullish effect on Ethereum's underlying spot price. Some people have used the term 90% reduction in the circulating supply of Ethereum. It's very difficult to predict exactly what it will be because Ethereum's not operating on a fixed supply schedule like Bitcoin. So you kind of have to use a little bit of speculation on what the supply will be. And what it fundamentally is essentially you map the amount of Ethereum being, Ethereum rewards given to validators against the number of gas fees or Ethereum tokens consumed by use of the network. And, if you map those two together and assuming that, demand and adoption of the network remains relatively constant, which is being conservative because in all likelihood, as DeFi grows, the Ethereum network is going to probably grow parabolically. So even using conservative data sets, you still see a dramatic, imbalance between gas fees burned and new tokens earned through the validating process. The other dynamic, so it puts an underlying bullish effect on the Ethereum price itself, the spot price, but it also essentially doubles the yield that stakers or people who are staking Ethereum can earn post-merge. So after September 15th, the amount of yield that you can generate by staking will, is forecasted to double. And that's very significant because that's going to draw in all type of yield-seeking investors. And yield-seeking investors are, they may enjoy a little bit of spot exposure, but they're primarily going to try to cover themselves and be delta neutral. And so, essentially, if you look at the Ethereum futures market, you can see that the Ethereum futures across all different durations are trading in backwardation, which essentially means that the futures price is trading significantly lower than the spot price. I think across all the different durations, you're looking at, I think the number I saw was a 3.68%. So roughly Ethereum futures contracts are trading at a 3.8% discount to spot price. And that's what you would expect to see if you had a market where there's a lot of market participants who have significant spot exposure and are hedging that spot exposure on the futures market to hedge themselves against an uncertain outcome, right? So if you had identified all the things I just mentioned, and you're an investor, with a significant amount of money, and you want to take advantage of that, well, we'll just go back to the Ethereum market or the Ethereum USD. You can see in this last rally, Ethereum, maybe you positioned right here. Investors bought a spot position right there. Who knows? But what we see essentially is on the previous rally, Ethereum strongly outperformed Bitcoin in spot price action. And that's kind of congruent with, people positioning for the upcoming merge. We can put the merge date out on the chart. Again, there's no guarantee. Again, this isn't exact, but it's roughly right here, September 15th, not the 19th, but this is a weekly chart. Again, it could be delayed or pushed back, but basically, going back to my initial argument, this is the type of behavior you would expect to see on the Ethereum Bitcoin chart if you had people positioning in spot. And then as the rally gets going, remember this is Ethereum Bitcoin chart, so Ethereum in Bitcoin terms. As the rally gets going, then you see the the investors or market participants hedging into the rally, and you can see that on the futures backwardation. So as the rally gets legs, you see that futures premium, or discount, I should say, get more significant with each leg up, higher into the rally. And what that tells you is that, uh, these market participants are just using the rally as an opportunity to hedge their spot exposure, which makes sense because, despite how bullish the things I just mentioned about, the spot price and the yield on Ethereum, it still is an uncertain outcome, right? We may think that it's a more likely outcome than not. I think anybody positioning for the merge would almost have to believe that it's a likely outcome, or else they wouldn't be positioning for it. But I think they also acknowledge the fact that it's an uncertain outcome, right? And it could never come to pass, or it could fail dramatically. So, from a risk reward perspective, the most normal thing to do in that situation is to cover your spot exposure and hedge yourself against that uncertainty. And that's what we see is we see the that futures backwardation peaking. I don't have a good graph for that, but you can go look at any Ethereum futures price, and you can see backwardation across all the different durations. So ultimately, the way I interpret that is you've got these investors in spot, hedged, roughly delta neutral, going into this event. So now what happens, when, then, so what you also see is that open interest is climbing steadily. So we can see that in this chart right here. So, this is just Deribit, but you can go to any other exchange and you're going to see similar things on those exchanges. Open interest is rising in Ethereum pretty dramatically, actually. Ethereum open interest on options contracts actually just overtook Bitcoin for the first time. But this is looking at the futures market. Now, what open interest tells you is that essentially the way I interpret open interest is a synonym for leverage, right? If open interest is going higher, to me, that means that leverage is going higher as well. And that's a complicated thing. It would take a whole video in itself. I don't really want to go down that rabbit hole, but basically, for all intents and purposes, when you see open interest rising, you can assume that leverage is also rising in the system. So, when people are hedging one-to-one, you can you can have a lot of leverage in the system and still be relatively delta neutral. So a good example of that is if you're leveraged on perps or perpetual future contracts, and then hedged with futures in the opposite direction. So a good example of that is back during the bull market in Bitcoin. Um, at the peak of the bull market, funding got crazy high. It got up to like 1% every 8 hours or so. So you could leverage up without a lot of delta exposure. So you could say you had a one Bitcoin trading account, just for ease of reference. You could short perps, uh, 10 Bitcoin, right? And leverage. So now you've got 10 Bitcoin short perps on a one Bitcoin account, and then buy 10 Bitcoin worth of long futures contracts to hedge those 10 Bitcoin short perpetual contracts one-to-one. So your delta exposure, again, it's not perfect, but it's roughly one-to-one, right? You're not directionally biased, assuming that the futures premiums don't increase or decrease dramatically. And then you can pull in the funding on that. So you can leverage up on that. And that was one of the strategies I did during the bull market. That you can run into some unique problems, but if you hit it right, you can, just basically because of the inefficiency in this market, you're just able to pull in an extreme amount of funding, leverage funding, while being hedged relatively delta neutral. It was almost like a free money printer. But now, now that the big boys are stepping in, I'm pretty sure they've arbitraged that. So that opportunity may not exist anymore, but I think a similar opportunity is presenting itself in Ethereum, not on the funding side, but just on the merge. But anyway, going back to the open interest, as you see open interest rising, that's just leverage. The point was just to illustrate that you can have, people say, somebody buys, a leveraged spot position, right, with some type of line of credit, maybe not marked to the exchange. So maybe they've borrowed and they're leveraged, 5-1, right? And they use that credit to buy spot, and then they hedge, they hedge that leverage by, whatever that 5-1 leverage spot position is. Then they sell enough futures contracts to hedge it 1-1, but they're still leveraged, right? They're still it's still a leveraged position, but it's being hedged to reduce some of the delta exposure. And I think that's what you're seeing now. So it's a good example of how you can. It's a long way of explaining how you can see um, leverage climbing under that scenario where people are hedging. Right, hedging doesn't necessarily mean that leverage is going down. It can go up while people are hedging. So anyway, going back to the timing around this, you've got these market participants hedging. So what happens at the merge date, right? There's really three options, right? The market expectation is that the merge occurs on September 15th, roughly. Again, it's not an exact date, but we can roughly say it's that week. So three things can happen, right? The merge can either happen, it can not happen, or fail miserably, fail in a way that it'll never happen, right? That just shatters the expectations of the market. It can succeed wonderfully, or it can be delayed. I think if it's delayed, that's a relatively non-event. But if it fails horribly or succeeds amazingly, then those are two events, and I think those are the two most likely events. And in that case, I think you'll see the open interest decline as people, these participants who've been gearing up for this event, pull their hedges off, and either dump their initial spot position for a incredibly unfavorable outcome of the merge, or dump their hedges, right, and then expose some of their long position. You know, what is essentially a leverage long position, if, with or without those hedges. Now, where it gets interesting is that the futures market is in backwardation right now. So, again, that just means that futures are trading at a discount to spot price. Now, if the merge is successful, really there's only, because of the bullish underlying nature of what that means for Ethereum price, what you would ultimately see is the Ethereum futures backwardation discount unwind and start trading into a premium. So right now the futures discount is at roughly 3.6%, and you would see that unwind and trade higher up to probably get very, very significantly higher into premium. Who knows how high it will get? But this market's pretty crazy. I mean, Bitcoin got up to north of 10% premium last bull market. That really wouldn't surprise me in Ethereum. So what would happen in that situation? Now, where that gets really interesting is when the premium gets that high up, it pulls bond type investors, yield seeking investors into the market. Because, well, first of all, the yield on Ethereum is going to be very significant during the merge. So it's going to be somewhere between 5 and 12%. So roughly, just use 8% as a number. That's significantly higher than the cost of capital for a lot of these people. A lot of these sophisticated players, even in the relatively elevated nominal interest rates right now, they're still able to secure leveraged capital for about 3% interest. And if just using a conservative number on the yield of Ethereum of roughly 8 or 9%, you're looking at a 6% gap, right? A 6% positive funding gap, which is huge. I mean, you don't like that. For people who are maybe not used to traditional investment, like that 6% may not seem like a big number, but just to put it in perspective, like these guys taking positive carry trades, they're looking at typically less than 50 basis points of spread. So like 6% positive carry is like insane. Um, and generally in like the bond market with high yield investments, like third world developing bonds can have high yields, but they also have high default risk, and it costs a lot of money to hedge that currency risk. And this is where it's really, really interesting in Ethereum is that, again, assuming that this scenario plays out and the Ethereum futures contracts trade into a significant premium after a successful merge, then bond investors get paid very handsomely to hedge their currency risk and hedge their spot exposure that they'll need to run a validator. So somebody like this is going to step in with a lot of capital, right? Maybe someone would step in with like $300 million, buy $300 million worth of spot on leverage. And, if they're leveraged, they can get up to $1 billion, cover it with futures. They're going to cover most of that with futures. But again, if the bull market's ripping, they get paid to hedge that currency risk in Ethereum. So just follow that scenario. We'll just use 500 million for the sake of reference. Market participant enters the market with 500 million of spot, and then covers that. Let's say they cover 50% of the spot exposure, and then they sell, and say the Ethereum premium is trading at 10%. Well, they just got paid 10% of half of that position to hedge that position. So if they're hedging half of that 500 million position, they're hedging 250 million, 10% of that is 25 million. They just got paid $25 million to hedge their currency risk, which is insane because normally in the bond market, you have to pay a significant premium to hedge your currency risk. So this is huge. Not only that, but the Ethereum yields under a successful proof of stake transfer will be as high or higher than a lot of the yields, in the traditional bond market, and the yields will be paid in a native token that has incredibly underlying pressure based on the supply schedule that we kind of identified before. So again, all in all, it's really a scenario where I personally, traditional bond investors are getting killed recently. And, I think they're kind of backed into a corner. There's really no good trade left to take in the traditional bond market. And these guys understand yield. And I think those yield-seeking investors with very large sums of capital are going to flow into Ethereum and take this positive carry trade. It's just too much opportunity to let go to waste. They're going to see dollar signs. And I think another element that kind of reinforces it is the fact that Ethereum can be marketed very easily as energy friendly, and that the transition to proof of stake is energy efficient. Not that I necessarily agree with that, but considering the climate crisis and the energy crisis, well, really the energy crisis is going on broadly in Europe, in France and Germany, where energy costs are soaring through the roof. That will probably be a very effective marketing campaign. So not only do you have a extremely effective marketing campaign, but you have extremely strong underlying fundamentals that would drive capital into this market. And for that reason, I'm extremely bullish on Ethereum. This is essentially my bull case for Ethereum. It's not financial advice, but make your own investment decisions. But I hope you guys got some value from this. Again, if you did, please just make sure to leave a like on the video, subscribe to the channel, and I'll catch you guys in the next upload.